Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his good friend, Mr. Jonathan Twomley. How you doing, sir?
I'm doing well, Michael. How are you?
I'm doing well. So I don't know if you saw the Fed, release yesterday. I've kind of summarized it as the Fed is going higher, the Fed is going faster, and the Fed is going to stay there longer than the market expects. And I wanted to ask you what you thought of that, and again, what might be the impact in the world that you play in, because you're playing in the big leagues, and I like to watch.
So this is what everybody expected. I mean, there were some people expecting a full point, but I think most people had settled around 75 basis points. That's what happened.
Mm-hmm.
I mean, what is going to happen in the multifamily market is that this is going to impact pricing. I mean, it's going to filter through to mortgage interest rates that people pay, and that is going to make it more expensive to buy deals. And that means that buyers are going to offer less, and there's going to be a period of time where sellers, are going to hold out for the high price that they had underwritten into the deal, but they are not going to get it because the buyers just can't afford to pay it with the higher interest rates, and frankly, the banks are not going to offer as much leverage, right? So
yeah, I want to hit that point again. I think people miss that. Rates are going up, but also banks will get more conservative. And what does that look like? Lower LTVs.
Yeah. So the way that works is when you do a commercial real estate deal, the bank requires you to earn enough money to cover your debt service and then some, right? And so typically the requirement is for your net operating income, which is all of your income before your debt service. They want that to be 1.25 times your debt service. So your NOI must be a multiple of 1.25x your debt service in order for them to give you the loan. Now, when I first started out, just kind of hearkening back to the last conversation a little bit, just by give you some background. Mm-hmm. When I first started out, the rule of thumb for what was a good deal, and by good deal, that was what was a deal that you as a sponsor were going to be able to make money on after you paid your investors what you promised them. You wanted to have a debt service coverage ratio of about 1.6, right? Mm-hmm. And so that if you could buy a deal for that price, you knew that you were going to make a lot of money for your investors and you're going to make some money for yourself too. Now, what happened was over time, and nobody would do a deal if you were unless there was some like massive opportunity that you could spot in the deal because the deal was somewhat distressed or there's a great repositioning opportunity or something, you would not buy a deal at a 1.25x ratio, right? You just, because there's no meat on the bone.
Exactly. No margin.
Not making any money on that deal until you sell, right? Or you get some fees up front, but you were not participating in the profits of that deal at that level. What happened? Over time, every deal was priced at that level, right? You basically got to the point where you were maybe, if you were really lucky, getting up to like a 1.3x multiple for NOI on your deals because there were so many players coming into the market and everybody was drinking the Kool-Aid. And so deals got priced basically up to the level that they couldn't go any higher than, like at that moment given where rents were, but if rents went up, they could, because your NOI grows, you could get a higher price. But in terms of that coverage ratio, you couldn't go higher than that at that moment in time. So now where does this lead us with higher interest rates? Well, the components of the major factor that determines what your debt service is the interest rate, right? So if the interest rate rises, the dollar figure that you have to pay each month on your mortgage goes up, right, at the same price. So if you hold the price constant, but you raise the interest rate, that chunk goes up. And when that happens, the bank is going to look at your deal and they're going to say, well, in order to meet this 1.25x threshold, we can only give you 65% leverage rather than 75% leverage, right? And what that means is that then the buyer has to do either one or two things. They have to go to the seller and say, hey, Mr. Seller, cut your price, or they have to raise more equity from their investors. If they raise more equity from their investors, that means lower returns. And then you've always got this issue of like, well, are your investors going to go for it or not, right? And also talking about our previous conversation, greed and fear, when interest rate in this environment where interest rates are going up, right? There's more people getting fearful. They're going to want a higher return to take the risk. And so for you as a buyer, well, raising more equity really isn't an option, because you can't be in this environment, you can't be offering a lower return.
Right.
You've really got to be offering a higher return. So then you've got to go back to the seller and say, hey, Mr. Seller, you got to cut the price. And, or, you know, if you're not in contract already, you're just offering less, right?
Yeah.
And so, and there's going to be a while where the sellers hold out and they're going to say, no, pay me what I want for this property because it's worth X. And the buyer's going to be like, no way, I'm not paying that. So there'll be a disconnect for a while until the sellers come to, you know, to reality. And now I think what's going to happen though with this additional interest rate, I mean, I'm looking at some deals right now, and I'm looking at one in particular here in New York City where I know that the seller put the deal on the market early, right? They were planning, they're still, you know, working on construction in some major construction projects, which they say, you know, they're going to finish before closing. Right?
Yeah.
And obviously, if we do go into contract, it'll be a contingency for closing.
Yeah, it'll be a requirement. Yes.
Yeah, that they do it. But the reason that, you know, even though they don't say this, I know the reason that they've rushed this to market is because they're trying to get in ahead of the interest rate rises that are coming. But, you know, then this interest rate rise hit yesterday, and I know that's going to impact their ability to sell this property.
Yeah. Well, let me just tell you what happened this morning, right? So I have a lot of experts. I got this from a mortgage guy this morning. So it says reprice risk high. This is, again, residential lending. It can be repriced every day. This AM brings the pain. Rate sheets will be bloody and frustrating. Reality is and it is likely to get worse from here. Today started bad, negative 20 bips, but got much worse around 9 a.m. We likely lock by day's end. Alert, 70 bips negative. 10-year now at 3.69. I just checked. It's actually at 3.71. The 10-year is up almost 20 basis points today. This is going to be bad.
Yeah. And that, you know, so a lot of, so when you talk about a multifamily mortgage, right, depends on what mortgage program you're in, but some mortgage programs are based off of the Treasury and some are based off of SOFR, right? Correct. Yep. And so, and usually the bridge debt is based off of SOFR.
What is the SOFR? Is just SOFR? Is that what it is?
Yeah, I believe so. It might be, yeah, I think it's SOFR, right? And it's what replaced LIBOR.
I don't have a quick way to look it up, at least, or I don't know how, but sorry. I tried to look it up.
I'm not exactly sure how that rate gets, I should sort of dig into exactly what is baked into that rate, but it's obviously affected by you know, interest rates and maybe less directly because it's got some kind of European component to it, like LIBOR did. So it's, if interest rates in Europe are still lower, it may still be a little bit lower, but that's basically for bridge debt. Like you're not getting bank debt or agency debt based on SOFR. Those rates are based on the Treasury because they're basically buying, they're building in a spread over the Treasury. Correct. Right. So, so if the Treasury is at 3.71, you know, typically you're talking 150 to 200 basis points of a spread. So now you're into the fives, you know, low fives or high fives, depending on how much spread they bake in. And if the banks are concerned that interest rates are going to go up further, they're going to bake in a higher spread.
Of course they are.
So you're talking about, you know, probably high fives right now for interest rates. And when people bought, you know, their deals and their interest rate that they paid was 3, you know,
very different.
That is a very different environment into which you have to refi, right?
Yeah,
so
exactly.
It's going to change. And on the bottom side too. Yeah.
Yeah. Again, I think, you know, I think residential is kind of in the same game. What I hear you saying, and I actually used this analogy the other day, is buyers are living in the future, sellers are living in the past.
Yeah.
And what that creates is, again, at least in residential, what I'm saying is the next 6 months are going to be like we're stuck in mud.
Yeah.
Eventually things will break one way or the other, and there'll be agreement and transactions will start to flow as normal. But in the short term, and at least in Resi, I'm calling it 6 months of just stuck in the mud, right? Because buyers are in the future and sellers are in the past.
I mean, I'm seeing some interesting stuff just anecdotally in the single family market, which I find interesting because there's a couple markets that I follow closely, like obviously around here where I live.
Sure.
And then also a couple of places in upstate New York.
Mm-hmm.
And they're actually diverging from each other. So what I'm seeing here in the city is stuff really sitting on the market, like driving around the neighborhood and seeing not a lot, but seeing for sale signs.
More than normal.
Yeah, and you didn't really used to ever see any for sale signs because they never needed to bother putting them up.
Why drive over and put the sign up? It's already sold.
Yeah, exactly. I mean, they'd have an open house and they'd get a bunch of offers and that would be it. They didn't need to put up a sign. Now you're seeing the signs up and that kind of, when you talk about investor psychology, that creates, all of a sudden you see some signs up and they're there for 2 weeks. And even though in the past 2 weeks was nothing, now people are like, oh, it's really hard to sell a house now. So then, so that creates like this thing where people are like, well, maybe I shouldn't buy a house now because the price is going to drop and I should wait.
Back to fear and greed. It all kind of feeds on itself. But
what I'm seeing, the opposite thing, I've been looking up in Ithaca, New York.
Ithaca,
right?
okay. Yep.
Stuff is flying off the shelves there. Like I'm on Trulia and I see like a house I'm interested in, I bookmark it. And like 2 days later,
it's gone. Wow.
Yeah. And so that's really interesting to me, like why that market is so hot right now. Maybe it's because like it's dominated by Cornell and you've got the academics. So you got like new people who've moved in because they've taken jobs at Cornell with a new school year. Maybe that's what it is, but it's been very surprising to me to see like these it's like boom, 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 like, up there.
Yeah.
So
so again, in residential, I think we're pretty slow for the 6 months, but does multifamily, like does it really have seasonality or not really? It's just, is there a seasonality aspect?
Less so. I mean, things do
I would think
kind of like slow down a little bit in the summertime, maybe because people are like on vacation and stuff, but it doesn't like go dead.
No, I wouldn't think so.
Yeah, and I think, and sometimes you see a rush at the end of the year where people are trying
taxes,
for tax reasons. But there's not a lot of seasonality like with the home market where people are trying to buy before school starts or what have you.
You've been in this game a little bit. How long do you think there will be this kind of just divergence between buyers in the past and sellers in the future? And would 6 months be, or could this go on for a year? Given rates go up, I mean, how long before this kind of unstuck?
So it's interesting because I got into the market right after the financial crisis, right? And I saw prices being sticky for a very long time, right? And like that people were asking for peak pricing and not budging off it. But I think some of that had to do with the fact that they were underwater on mortgages, like they couldn't sell for less than a certain amount, right? So, so it took a long time for that to readjust. So I've been very surprised this time around, where what I've been seeing and hearing is sellers being more flexible than I would have anticipated, even with deals under contract, because they kind of see what's going on. Now, I know that there are definitely some sellers who are still holding out for their price, and maybe some people who are not, if they're not forced to sell, they may just say, you know what, the hell with it, we'll hold it for another 5 years.
Yeah,
right?
We've owned it for 15, why not 20?
But I know that there are other deals like one that I'm looking at right now. These partners want out, right? They want their money back. This is an owner that usually just buys and holds forever, but for this particular property, they've got a partnership issue and the partners want to sell. So they're kind of like, they don't have that option of being able to wait another 5 years. And unless they convince their partners to wait, I think you're going to see situations like that have to sell. And then there'll be people who, they've worked through their hold period. It's time to sell. Their investors are expecting their money back. And if they bought early enough,
They'll
well,
be
look,
okay.
it's only their unrealistic expectation that was set at the height of, the COVID bubble that's disappointed, but their overall returns are going to be
Yeah,
just fine
yeah.
because they bought in 2015, 2016, what have you. So you'll see, I think, those deals
Okay.
starting to trade, because the sellers will just realistically go like, hey, we've got to refinance, our debt is coming due, we've got to refinance, we can refinance, it should be fine, but like it's kind of time to exit, and let's just exit. We'll take not our lumps, like I said, they're going to do fine because they bought early enough.
Yeah.
The people who are going to be the ones who will potentially be, holding out for high prices, but then forced into a distress situation, are the ones who bought at the top with bad debt and can't refinance, right?
Yeah.
So, yeah.
It's going to be fun to watch. Again, I appreciate you coming back every week. You have a very fun and interactive Facebook group. What is that, so people can go join?
Yeah, so it's called the Multifamily Investment Community, and just swing by, fill out the couple questions that I ask you to fill out, which basically, please don't spam us. That's kind of what I ask you to promise. And yeah, come and join the conversation. It's a great group.
Yeah, and do me a favor, folks, if you do join, let them know in one of the questions you came from One Rental at a Time or ORAT. It's always nice to see a return for Jonathan giving us an hour of his time each week that the people are coming. So thank you.
Yeah, and those are always instant approves. When I see that, it's like, you're in.
You're awesome. All right. Thanks, buddy.
Thank you.